Hey everyone, welcome back to Corporate Decoder, the place where we will dig into CSLM Digital Asset Acquisition Corp. the Third Ltd's latest 10Q filing. And let me tell you, this one is a wild ride, especially if you like SPACs and the drama that comes with them. So what exactly is CSLM Digital Asset Acquisition Corp. the Third trying to do? Well, they are a blank check company. Think of them as a company that goes public with the sole purpose of finding another company to buy or merge with. They are on the hunt for a target business, and as of the 30th of September 2025, they had not found one yet. Their whole game plan hinges on this upcoming business combination, so the numbers we are about to see are very much in the pre-operational phase. If you love getting straight insights from complex corporate documents, make sure you are subscribed. We also have a fantastic community on Discord linked in the description below, and you should definitely come hang out. Let's dive right into the financial statements, starting with the balance sheet. This is like a snapshot of what the company owns and owes at a specific point in time. At the end of September 2025, the company had a whopping $230 million in treasury securities held in a trust account. This is the money they raised from their initial public offering, the IPO, and from private investors. It's essentially set aside specifically for that business combination they are looking for. Now compare that to the 31st of December 2024, where this number was zero. This stark difference tells you they went from having virtually nothing to hold on to for their big acquisition to having a substantial war chest in just a few months. Because of this IPO money, their total assets jumped from a mere $35,480 at the end of 2024 to over $234 million by September 2025. That is a massive leap. Now here is a really important bit for SPACs. The Class A ordinary shares are subject to possible redemption. What does that mean? Well, the investors who bought these shares in the IPO have the right to get their money back if the company doesn't find a suitable business to merge with within a certain time frame, which is typically 24 months. This is why this big chunk of money is in a trust account and is classified differently on the balance sheet. It is not fully owned by the company yet. It has strings attached. By September 2025, almost $230 million worth of these shares were in this redemption category. On the flip side, their accumulated deficit, meaning the total losses the company has incurred since its inception, is a little over $5.6 million by September 2025. This number is not surprising for a SPAC because they are not generating any revenue yet. Their expenses are primarily related to the IPO process and operational setup. Looking at their statement of operations for the 3 months ending September 2025, we see about $210,000 in formation, general, and administrative expenses. For the 9 months, that's over $300,000. These are the costs of setting up the company, finding potential deals, and all that jazz. The most interesting part here is the interest income on the trust account, which is $876,657 for both the 3 and 9 month periods. This basically means the money parked in the trust account is earning a decent amount of interest. They also have a share-based compensation expense of $559,000. This likely relates to the founder shares or options granted to management and is a non-cash expense, but it signals the cost of attracting and retaining talent. The net result for the 3 months ending September 2025 is a profit of about $91,000. However, for the 9 month period, they reported a small net loss of just under $1,200. This little profit in the quarter is mostly driven by that trust account interest income, not by any actual business operations. Now let's glance at the statement of changes in shareholders' deficit. This table really shows how the company's equity has been shaped by its activities. You can see here the IPO and the sale of private placement units brought in significant capital. However, the remeasurement of temporary equity to redemption value is a huge number, nearly $20.3 million. This is an accounting adjustment reflecting the change in value of those redeemable shares. It's a significant factor that eats into the shareholder equity. The condensed statements of cash flows tell a clear story. For the 9 months of 2025, they brought in $230 million from the sale of units in the IPO and another $8.9 million from the private placement units. They then invested $230 million into that trust account. Pretty much all the IPO money went straight there. Naturally, there were significant payments for underwriter fees and commissions totaling over $4 million in cash plus another $9.2 million in deferred fees. This deferred fee is a big one. It's contingent on them completing a business combination. If they don't, the company might not have to pay it, but if they do, it comes out of the trust account money, which impacts what is left for shareholders. Looking at related party transactions, the company entered into an administrative services agreement with its sponsor. They agreed to pay $30,000 per month for things like office space and support. As of the 30th of September 2025, they had accrued $34,839 in this category, but had not yet paid it. There was also a promissory note from the sponsor for up to $300,000 to cover offering costs. This was repaid in full as part of the IPO proceeds. It's interesting to note they overpaid the sponsor by about $2,300, which is now a receivable from the related party. In terms of fair value measurements, they have this figure of over $5.1 million for the fair value of public warrants. This is an estimate and it's classified as a level 3 input, meaning it is based on unobservable inputs and valuation models. Essentially, they are valuing these warrants which are part of the IPO units. For the public warrants, they used an estimated implied volatility of 2.20% in their valuation model. This is a measure of how much the price of the underlying shares is expected to swing. The underwriting agreement details are pretty standard for a SPAC. They paid a cash fee and have a deferred fee, which is a significant chunk of money to be paid only if a business combination is completed. The Class B ordinary shares are held by the sponsor and are typically for the management team. They have different voting rights and will convert into Class A shares upon a business combination. By September 2025, the sponsor held over 7.6 million of these shares. Now let's talk business strategy and the implications of these numbers. As of mid-November 2025, the company had about 23.9 million Class A shares and over 7.6 million Class B shares outstanding. Remember, a big portion of those Class A shares are the redeemable ones we talked about. This is crucial because if a lot of shareholders decide to redeem their shares, it significantly reduces the cash available for the business combination. This filing is very upfront about the risks. They state that factors described in their prospectus could cause actual results to differ materially. This is standard boilerplate, but for a SPAC, the biggest risk is always that they won't find a suitable target business to merge with within their timeframe. If that happens, the money in the trust account is returned to shareholders, and the sponsors and management essentially walk away with nothing from the public offering proceeds. They even explicitly state they cannot assure you that their plans to raise capital or complete a business combination will be successful. This is a candid admission of the inherent uncertainty in the SPAC model. So what is the bottom line here? CSLM Digital Asset Acquisition Corp. III is in the critical phase of a SPAC's lifecycle. They have successfully raised a substantial amount of capital in their IPO and are holding it in a trust account, ready to deploy for an acquisition. Their reported financials reflect the costs of this process and the income generated from their trust account investments, not from operational business. The key takeaway is that their future hinges entirely on finding a viable business to merge with. If they fail to do so within the specified period, investors will likely get their money back and the company as it exists will essentially cease to be. The risk of not finding a deal is very real, and the company is not shy about highlighting it. The market for SPACs has been quite challenging and investor appetite for these vehicles has waned, so the pressure is on for them to find a compelling target quickly before investor patience runs out or the deadline passes. Alright, that is our deep dive into CSLM Digital Asset Acquisition Corp. III Ltd's latest filing. What is your take on these SPAC numbers and what they signal for the company's future? Do you generally steer clear of SPACs or do you see opportunities? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more straightforward breakdowns of corporate documents just like this. And hey, don't forget to check out the Discord community linked in the description below for more insights and discussions. Thanks for watching. Until next time.